In this lecture, we are looking at accruals, also called accrued expenses. Accruals arise when a business has used a service but has not yet received the invoice or made the payment. Typical examples of accrued expenses include utilities used but not yet billed, staff bonuses earned but unpaid, and audit or professional fees. In all these cases, the business has already benefited from the service. Accruals affect all three financial statements, but in different ways. On the profit and loss, the expense is recognized in the period it is incurred. On the balance sheet, the accrual is shown as a liability. On the cash flow statement, there is no impact until the cash is actually paid. So, an accrual is an expense incurred in the current period, but not yet invoiced or paid. Accounting rules require us to recognize the expense now, even though the cash will be paid later. Let's look at an example. A utility bill for December 2025 is received in January 2026. The cost incurred for December is £1,200. Step 1 is to ask, does this cost belong in December's profit and loss? The answer is yes, because the utilities were used in December. Even though no invoice was received, we must recognise the expense. In December, we debit utility expense £1,200 in the profit and loss and credit accrued expense on the balance sheet. This shows that we have recognised the cost and recorded a liability. In January, the invoice is received and paid. The accrued expense is reversed and replaced with a trade payable, which is then settled. There is no profit and loss impact in January 2026 because the expense was already recognised in December. Now let's look at a professional fee covering January, February and March 2025. The total cost is £900 and the invoice is received in April. The cost is spread evenly over 3 months, so £300 per month is incurred. In each month, we recognise £300 in the profit and loss and increase the accrued expense on the balance sheet. Let's look at January. The service is used in January, no invoice received yet. Because the cost relates to January, it must be recognised in January's accounts. We debit professional fees in the P&L and credit accrued expense in the balance sheet. No impact on the cash flow in January. The service continues in February. Still no invoice received. February professional fee cost must be recognised in the P&L and balance sheet. Cumulative balance sheet accrued expense now totals £600. No cash flow impact yet. March is the final month of the service. Invoice is still not received. The final portion of the cost is recognised. Journal entry is debit professional fees in the P&L and credit accrued expense in the balance sheet. Cumulative balance in accrued expense balance sheet is £900. No cash flow impact yet. In April, invoice for £900 is received and paid. There is no expense recognised in April because the cost was already recognised in earlier months. The accrued expense in the balance sheet is cleared when the invoice is received. Cash flow is £900 cash outflow as the invoice was paid. Let's now walk through this example month by month using the table. At the top, we have professional cost in the profit and loss. In January 2025, we recognise an expense of £300 because the service was used in January. The same happens in February and March. Each month we recognise £300. You'll notice that April shows no expense because no service was provided in April. Now let's look at the accrued expense, which is a liability on the balance sheet. In January, the accrued expense is £300. In February, it increases to £600 because another month of cost has been incurred. In March, it increases again to £900, which represents the total amount owed. In April, the accrued expense balance goes back to zero because the invoice is received. Looking at the bank account, there is no cash movement in January, February and March. Cash only leaves the business in April when £900 is paid. This shows clearly that cash flow timing is different from expense recognition. When the invoice is received in April, the accrued expense is cleared and replaced with a trade payable. Once the invoice is paid, the trade payable balance returns to zero. This example demonstrates the accruals principle. Expenses are recognized when they are incurred, not when they are paid. The profit and loss reflects the correct monthly cost. The balance sheet shows what is owed at each point in time, and the cash flow statement reflects only actual cash payments.